Greetings, grade 12 learners, and welcome to today's accounting lesson. My name is Mr. Simbi, and this lesson is brought to you by the Gauteng Department of Education in collaboration with Sabono Discovery Center. Once again, good afternoon. We are going to begin a very interesting topic today. So we're starting a new topic completely. In the past weeks, we have done the statement of comprehensive income. We've also done the statement of financial position. I would want to encourage you to visit the previous week's classes so that you can catch up on what we have done so far. In today's class, we're beginning something that is very interesting. So this is a new topic in grade 12, and we call it cash flow statements. Here are my objectives in today's class. We're going to do the cash flow statement and notes. So you will find that there are several notes that we've done when we prepared the statement of comprehensive income as well as the statement of financial position. And then some of those notes will affect our cash flow statement. But there's a new note that I'm going to introduce you to today. All right. So that is a new note that relates to the statement that is your cash flow statement. All right, so what do I need if I'm to prepare a cash flow statement? You will need information from the statement of comprehensive income. All right, so you will need information from your income statement, that is the statement of comprehensive income. So you'll find that all this information, we have seen it when we're preparing the statement of comprehensive income. You will need this information. You also need information from the statement of financial position. So here we're going to look at our current assets, current liabilities, your SARS income tax, shareholders for dividends, your fixed assets, all of those things. We're going to look at them in today's class. And then lastly, you're going to need some notes to the financial statements, such as your fixed asset note, your share capital note, your retained income, and some calculations that we have done on your dividends. Okay. Now, here are the components of the cash flow statement, the components of the cash flow statement. Our cash flow statement will be split into three parts or three components. So the first component is what we call the operating activities, which is this one here, our operating activities. Now, this part or this component represents the core function. This is the main function of the business, all right, which is to make profit. That is the reason why this business was established in the first place. So when we look at our operating activities, we are looking at the activities whereby we are engaging in the operations, the core functions of this particular business. And then we will look also at what we call investing activities, which is now the purchasing of necessary assets to achieve the objective of generating a profit. And then lastly, we'll look at financing activities, which is finding the money, that is the source of money. And then we have own capital as well as borrowed capital. All right, so I want to rephrase this thing and I want to say it again, all right, in a different way. So I want you to listen to me now. When a company is established, one of the main important things that the company needs to have is capital. And we understand that we have two forms of capital. In other words, two sources of capital. So we have our own capital. All right. Remember, we are a company, so we get our own capital from issuing shares. All right. And then there's capital that we borrow. Now, this is from financial institutions like your banks. So we borrow and we call that loans. So far we have two sources of finance. Own finance, that is after issuing shares, borrowed finance from the banks. When we have the finance, then we will invest that finance. So you see now, I'm going back now. We will invest that finance. How do we invest it? By purchasing the necessary assets to achieve the objectives of generating profit. So we know that in order for us to generate profit, we need to have the necessary assets. So first we get the finance, After we have the finance, then we acquire the necessary assets. After we have acquired the necessary assets, then we can go and operate. Did you see the flow now? So we have to have the finance, and then we invest by acquiring the necessary assets, and then we then go and operate. But as we prepare our statement of the cash flow statement, you will see that we're going to begin with our O, that is operating activities, investing activities, and then we look at our financing activities. Okay, so here's the format. All right, so on the format, we are talking about the O, the I, and the F. All right, so it is your O, your I, and the F. So the O stands for cash effects of operating activities. Cash effects of operating activities. Now, you will get 4 things in here in your cash effects on operating activities. You get 4 items there. Item number 1 is our cash generated from operations. Once you don't see a bracket, that means that amount is an inflow. All right, so we are going to have cash generated from operations, and that will be an inflow. And this amount, we'll get it after we have opened a note. Okay, so in your mind, just think note. We're going to open a note very soon. The number 2, we have what is known as interest paid. And as you can see, there are brackets there. So this, therefore, is your outflow. That is your outflow. All right. And then I'll come to the third one, which is dividends paid. Dividends paid. With your dividends paid, it is also an outflow. This is an outflow as well. And then lastly, you have your income tax paid. Once you hear the word paid, you should know that that is an outflow. Okay, hence you see brackets over there. Now, the next part is what we call cash effects of investing activities. Cash effects of investing activities. You will see that the first one is talking to fixed assets, and the second one is talking to fixed assets. So that simply means we're fixed assets appearing twice in this case. All right. So the first one, which is number 1, is your fixed assets purchased. When we purchase fixed assets, that is a cash outflow. When we purchase fixed assets. But we also get to dispose our fixed assets. We can sell them. And once we sell them, we get what we call proceeds on sale of fixed assets. That one becomes your cash inflow. Hence, no bracket over here. And then the next one is your fixed deposits. All right. Remember the statement of financial position. Under your non-current assets there is 2. There is your fixed assets, and then there's your financial assets. That is your fixed deposit. So your fixed deposit will come here. When you have a decrease in fixed deposit, normally we say that the fixed deposit has matured, and you remember that that amount will then be cash that the business is receiving. So that will become an inflow over here. And then the last part of the cash flow statement is cash effects of financing activities. And then remember, we spoke about the 2 sources of finance. We spoke about shares. So you see here, I have shares and I have shares. That means my shares are appearing twice. So the first one is the proceeds from issue of shares. Once I issue shares to the public, that becomes an inflow. Once I issue shares to the public, that is a cash inflow. So we have issued shares, then we receive cash inflow. But remember, we get to repurchase some of the shares. So once we repurchase, that becomes a cash outflow. That is on the repurchase. Change in loans. All right. So when we have acquired a loan, or when we have a loan that we've received from a bank, the moment we pay that loan, it will decrease. And the decrease in the loan is a cash outflow. But also keep in mind that we can also receive a loan. Okay. And then lastly, we come to the last part of the cash flow statement, which is the changes in cash and cash equivalents. To explain this part, we're going to do it practically in today's class. So what we have done, there's a worksheet that has come to your school already. You must have received a particular worksheet, and we're going to work from that worksheet in today's class. So if you have that worksheet and it has been printed out for you, then I'm going to do certain calculations from that particular worksheet. Okay. Now, remember the components of the cash flow statement. So this is basically the very same thing. So you have a cash flow from operating activities. Let's suppose you have 80,000 here. All right. After you've recorded all your 4 items, and then cash flow from investing activities, and then you have your negative 100,000. Remember, once it's negative, it must always be in brackets. And then you have a cash flow from financing activities, which is 60. Then you will see that if you come and add up all these ones, taking into account that that is a negative, you now end up with net change in cash and cash equivalents, which is 40,000. Then you come and say cash and cash equivalents at the beginning of the year, which is 10. At the end of the year, you end up with 50,000. All right, so I'm going to show you today how to add up all these figures to the point that you end up with that cash and cash equivalents at the end of the year. All right, once you have done your note for cash generated from operations, which I'm going to teach you in today's class, you will see that we're going to take it to the cash flow statement. In other words, if you want this amount, that is the cash generated from operations, you have to open a note. That is the note for cash generated from operations. Don't worry yourself. I'm going to show you today how to do this particular note. This is the format of the note in question. All right. So this is your note where you calculate your cash generated from operations. All right. So you will see that you begin with the net profit before tax, and then you will add your depreciation. Remember, depreciation is a non-cash item. So you will add back your depreciation, because remember, when we prepared the statement of comprehensive income, we had subtracted it together with other operating expenses. So in this case, we add it back. And you also add back interest expense. The reason being, when we are preparing the cash flow statement, we will see interest paid appearing on the face of the cash flow statement. So we're going to subtract it, and then later when we do the cash flow statement, you see us subtracting it in the cash flow statement. And then after that, you then get what we call operating profit before changes in working capital. And then the next thing is going to be the changes in working capital. On the changes in working capital, you're going to look at the change in inventories, the change in receivables, and then you change in payables. Then you get this amount, which we will then take to the cash flow statement. Okay, let's do an activity together so that we can really engage ourselves. Remember, there are certain things you always need for our class. You need a pen, you need a pencil, you need somewhere to write. That is, if you don't have the worksheet that was sent to your school, then you can use any piece of paper as long as you can be able to refer back to it. I'm going to be doing activity 1, and activity 1 is from the Free State Prelim for the year 2023. So let's look at the Free State Prelim for the year 2023, and my focus is going to be on question 2, which was the cash flow question. Okay, in this question, they were asking specific things that we're going to answer, but as I said, we're doing that note, all right, and then I'm going to do the very same note with you now. Okay, the demands of the question are as follows: cash flow statement and financial indicators, Free State Suppliers Limited. You are provided with information relating to Free State Suppliers Limited for the financial year ended 20 February 2023. Required. Complete the note to the cash flow statement. Reconciliation between profit before tax and cash generated from operations. And they were rewarding 13 marks for this question. Okay, let's see the information that we're provided. we have an extract of the statement of comprehensive income, all right? And then secondly, we have an extract of the statement of financial position, all right? And then we also have a further breakdown of the statement of financial position where we are given the notes to the statements of financial position. All right. So we have a note for trade and other receivables, and we also have a note for trade and other payables. Okay. So let's begin. Let's begin. So remember now, when we're doing our note, that is the reconciliation of profit before tax to cash generated from operations. We begin it first with net profit before tax. Net profit before tax. Very important. Net profit before tax. Now, when we come here, you will see that in our question here, we are given net profit before income tax, which is 2.4 million. So here we don't have a problem. We're just going to take that 2.4 million, then we come here, net profit before tax, 2.4 million, like that. All right. I hope you're writing together with me. All right. I hope you're writing together with me. So what I've done, I have taken my net profit before tax here, which is my 2.4 million. And then you can see already here, I'm guiding you. The next thing is to add depreciation. Why? Because this is a non-cash item. So I'm going to come and add my 185,700. So I'm coming here to say 185,700. That is my depreciation. Are you still following? Thank you. All right. So after depreciation, what is the next thing? You can see already here. I'm going to come and add my interest expense. All right. And how much is that interest? You see here, interest on loan, 175,000. So I'll come here and I'll add my 175,000. I add it there. So it means now I can add these three figures and it should give me my operating profit before changes in working capital. My operating profit before changes in working capital. Now, pull out your calculator. You're going to say 2,400,000 plus 185,700 plus 175,000. Did you get those three figures? I'll repeat them again for you. It's your 2.4 million plus the 185,700 and the 175,000. Once you have those ones, you now have your 2,760,700. Okay, 2,760,700. That therefore gives you your operating profit before changes in working capital. After this, then we're going to go to the next part of our note. Okay, so we've done the first part. What do? We had our net profit before tax, we added back depreciation, we added back interest expense, and we ended up with operating profit before changes in working capital. All right, let's quickly go on now. Then the next part, okay, we are now going to come to the changes in working capital. The first one is going to be the change in inventory. It is very important that you understand from which year we are coming from and to which year we are going. We are coming from 2022. We're coming from 2022. And we are going to 2023. Okay? So if you look at your inventory, in 2022, our inventory was 1,281,500. That was our inventory, 1,281,500. But in 2023, our inventory is now 1,350,000. So here you can see that there's an increase. I'm just going to come here and I'm going to say increase. It's a change, and the change is an increase in inventory. Okay. You have to understand that there's a relationship that is there between inventory and cash. All right? Inventory and cash. Keep that in your mind. When inventory increases, we will consider that to be a cash flow in the cash flow statement, an outflow rather. So I'm going to come here and I'm going to say an increase in inventory. An increase in inventory is a cash outflow. All right, I hope you're taking these notes down. An increase in inventory is a cash outflow, but a decrease in inventory would have been a cash inflow. So when inventory increases, it's a cash outflow, but when inventory decreases, it's a cash inflow. Okay, now why would inventory increase? Because we've acquired more. So it means the business is paying, hence it's a cash outflow. Why would inventory decrease? Because we are selling. When we sell, the goods are going and then cash is coming in. The relationship between inventory and cash moves in opposite direction. When inventory is going out of the business, cash is coming into the business. Can I say that again? All right, I'm going to repeat it for you. When inventory is going out of the business, cash is coming into the business. So when your inventory is decreasing because you're selling, cash is coming in. That's a cash inflow. Coming in, inflow. But when your inventory is increasing, that means inventory is coming in now. When inventory is increasing, that means inventory is coming in, and your cash therefore will go in the opposite direction, that is out. So we're talking outflow. An increase in inventory will therefore be a cash outflow. In this case, what do you see? Is it an increase or a decrease? It is certainly an increase, because you have 1,281,500 here, and then here you have 1,350,000. So we have an increase. I'll come here now. I want to show my calculations. What do I say? I'll now say my 1,281,500 minus 1,350,000. Remember, we have already established that once inventory increases, it is a cash outflow. And once I have a cash outflow, I must have my brackets already waiting for me. All right? Now, I want the difference between your 1,281,500 with 1,350,000. How much is that difference? Thank you. You said how much? 68,500. Thank you so much. So you get your 68,500. What is that? A cash outflow. Why so? Because inventory increased. Once inventory increases, it is a cash outflow. In the next activity, I'm going to give you another trick again. Okay, so please tell your friends that class is on, and once class is on, we need to tell our friends that they may join today's class as we are doing the cash flow statement. Okay, can I move on? Okay, cool. Let's go on to the next aspect. The next one is now our change in receivables. Change in receivables. You'll find that up here you were given receivables, which is 1,530,000 and 1,580,000. And then later these amounts were broken down here. Now you can see they were broken down. Now you must not use these figures to get the increase or the decrease. You must not use these amounts at the top here, because these amounts include, number one, your SARS income tax. You will not include SARS income tax when we do the increase or the decrease. Why? Because SARS income tax will be shown separately on the face of the cash flow statement. So the SARS income tax, I am not going to touch it. So you see, I've drawn a straight line across it. I'm not going to touch that one. All right. What else do I have? I have accrued income. Am I going to add accrued income? Yes, I'm going to touch my accrued income. So I'm going to add those two, and I'm going to add these two. Can I see your calculators? Let's begin. So if I say 1,554,000 plus 26, that's going to give me 1,500,000 what? Thank you, 580. All right, 1,580,000. Let's come here now. It's 1,420,000 plus 35. That will give me 1,400,000 what? 55. Okay, thank you. So you see what I've done there? I have excluded SARS income tax, because SARS income tax will be dealt with separately on the face of the cash flow statement. So here I've excluded it completely. All right, so when I come here now to do the change in receivables, remember, we're coming from 2022 going to 2023. All right. What are receivables? These are amounts that include accounts such as your debtors. When your debtors decrease, it means they're paying. It's as simple as that. Okay? When your debtors are decreasing, it means they're paying you, cash inflow. But if your debtors are increasing, that means they're not paying you, and we consider that to be cash outflow. Okay? So I'm going to say it again. An increase in your receivables will be considered outflow. An increase is outflow. And a decrease is inflow. Remember what I said about the decrease. When your debtors are decreasing, it means your debtors are paying. And when they are paying, it's cash inflow. So what do we see here? We see an increase. So I know it's a change. I'm just going to come in and say increase in receivables. Let's see the calculators now. I'm going to now say my 1,455,000 minus my 1,580,000. Remember, what do we have here? We have an increase, and we've already ascertained that once it's an increase, it's cash outflow. So here I'm going to have my brackets already before I even punch in the figures. Now, have you calculated already? 1,455 minus 1,580. How much do you get? Thank you so much. 125,000. That is very correct. That is very correct. 125,000. Inflow, outflow, outflow. Why is it an outflow? Because our receivables increased. If they decreased, it was going to be what? Inflow. You're correct. You're correct. All right. Can I move on to the next one now? Okay. Here's the next one. Trade and other payables. All right. I'm going to record my trade and other payables there. I'm going to ask you, do I use these figures here at the top? Certainly not. Okay. Why not? Because in the figures down here, you have what? SARS, income, tax. What do? I draw a line across it. I'm not going to include it. As well as your shareholders for dividends. You're going to draw again another line across that. All right. Why? Because your dividends are going to be shown separately on the face of the cash flow statement. All right. I've said that when we touched tax earlier on, and it's the same reason when we are touching our dividends. These amounts will be recorded separately on the face of the cash flow statement. So when we look at the increase or the decrease, when we are on the working capital changes, we will not consider these amounts. Which amount are we going to take? We'll take the 1,586 and the 1,347. Okay, let's start with the simpler way to understand. Trade and other payables. These are amounts that we must pay, payables. If your payables decrease, that means the money that you owe is decreasing. It means you have paid. Yes, it's as simple as that. If the money you're owing has decreased, it means you have paid. And once you pay, it's a cash outflow. But if your payables increase, we therefore consider that to be cash inflow. Okay? So you can see it's different now from our receivables. Completely different from our receivables. All right. Now let's look here. We have 1,586. We have 1,347. What do we see there? A decrease. What does a decrease mean? A decrease means we have paid. All right. So I'm going to come here and I'm going to say a decrease in payables. It is a decrease in payables, and I'm now going to say your 1 million. I'm going to take my 1,347,000 minus the 1,586. 1,586. All right. Now, remember, it is a decrease from 2022 to 2023. It is a decrease. That means we have paid. Once we pay, it's a cash outflow. So that means already here, I have my brackets ready. Then I just need to get the difference between these two figures, which is how much on your calculators? 239,000. Okay, 239,000. Once I am done with this part, then we can wrap up the entire question now. So remember, we started with net profit before tax, and then we added our depreciation, we added our interest expense, and then we got our operating profit before changes in working capital. Then we came to the changes in working capital. To get the changes in working capital, we started off first. Okay, remember we did these three aspects here. We did these three aspects here. We started with inventory, whereby it was an increase in inventory, cash outflow. And we came to our receivables, whereby we had an increase in receivables, cash outflow. Then we came to our payables, where we had a decrease in payables. We paid our debts, decrease, cash outflow as well. Then we add these three amounts, then they give us the 432,500. 432,500. Then you now say your 2,760,000, your 2,760,000 minus 432,500. That is how you end up with your 2,328,200. That is what we have there. And once you have that figure, then you can bring it now to the cash flow statement. And in the cash flow statement, that amount will come to your cash generated from operations. You come in, then you say 2,328,200. That is how we do it. So you need to know the note, because the note will assist you to get amounts that you record in your cash flow statement. Are we good? All right, thank you. If we are good, then we are going to move on now to the next activity, which is activity 2. Activity 2. Activity 2, we have extracted activity 2 from the Gauteng prelim for the year 2022. And we did a bit of changes to that particular question, not in terms of its information that was given, but mainly on the answer book. Mainly on the answer book. We wanted to be able to answer everything. You see that on your answer book, there are some spaces that you were not required to write. How do you know? Because it's shaded. Remember, once you see a space that is shaded, you don't write on that space. But for today's class, if you check on the worksheet that has been sent to your school, we removed some of the shaded places because we want to prepare the entire cash flow statement. All right. So we're not going to leave any particular space in this class. But remember, when you're in the exam, if you see a shaded place, it means you don't write on the shaded place. But in this activity, because we're going to do it together, I've removed some of the shaded places, so we're going to complete it entirely. Okay, are you good? All right. So if you're good, let us therefore begin. Activity 2 is from the Gauteng prelim for the year 2022. Let's go. It says, Severance Limited. The information below was extracted from the records of Severance Limited. The financial year ends on the 28th of February in the year 2022. All right, so we have that extract there. I think already now we know what to do once you're here. Oh, this becomes easy now. This becomes easy. All right, so here we need net profit before tax. But what are we given? We're given income tax, which is 28%. What must I do now? Okay, I remember now what we did when we were in the statement of comprehensive income. You remember, we had what we're calling net profit before tax, and that was 100%. I don't know if you remember. Yes, and then we also had income tax. In this case, income tax is 28%. So I'll come and say minus 28%. And it would give us net profit after tax. All right, which would be 72%. One of these three must have a rand value. Which of these has a rand value? The 2,072,000. So that one is for your income tax, 2,072,000. What is the next thing now? What you want over what you have times what you have. Okay? It depends on what you call it in your school. Okay, so here we're simply going to come and say, what is it that we want? We want net profit before tax. What is that? 100%? 2872? It is 100%. We want 100 over what we have. What we have? We have 28. So it will be over 28. Multiply this by 2,072,000. Multiply this by 2,072,000. That will give me net profit before tax of how much? Can I see your calculators? All right. Okay, let's see if we can punch this one together. So what we did, it was very simple. We simply said what we want is 100 and what we have is 28. And then we came and we said multiply that by your 2,072,000. 2,072,000. Do you see that? And then how much does it give you? It gives you 7,400,000. 7,400,000. So that means I'm going to bring that 7,400,000 here now. All right. So I'm going to come here. I'm going to say that will give me 7.4 million. 7.4 million. My next aspect, you can see already, plus what? Depreciation. So I'm going to come here and say plus depreciation. How much is my depreciation? Or you can see that one, can you? 320,000. Depreciation must be added. Why? It is a non-cash item. Then we come and we add again interest expense. Why? Because we're going to record it separately on the face of the cash flow statement. So we're going to come here, then we're going to say interest expense. And how much is that? 219,700. So I'm going to come here, it's 219,700. I need calculators now. I need calculators. We are now adding your 7.4 million plus the 320 and the 219,700. How much do you get? Say it again loudly. 7 million. You get 7,939,700. 7,939,700. What do we call that? That is our operating profit before the changes in working capital. Let's go on. Where do we go now? Changes in working capital. Now, on our changes in working capital, the first thing is inventory. Do you remember what I said about inventory? All right. And you remember I promised you that I'm going to give you another formula. Let's see if I can give you another formula. Inventory is an asset. Once you are dealing with assets, we're going to call this the calculator method. Okay? We're going to call it the calculator method. And then we're going to say, once it is an asset, we'll simply say the previous year, that is your 2021 previous year, minus your current year, that is 2022. And we trust in the calculator. Whatever the calculator gives us, if it's a positive, it's inflow. And if it's a negative, it's outflow. You still with me? Okay, let's see. Our change in inventory, here's our inventories over here. It is 110,250 and 561,880. Already you can see that we have an increase in inventory in this case. That is an increase in inventory. And if it's an increase, that's a cash outflow. But let's see this calculator method that we're talking about, if it will work. All right, let's see if it will work. So we're coming to our inventory. We're now saying the previous year minus the current year. Which one is the previous year? 2021. How much is in 2021? 110,250. 110,250. Then we say minus the current year. How much is the current year? 561,880. How much do you get on a calculator? A negative, very important, a negative 451,630. So already I know once I have a negative, it's a cash outflow. All right. So I'm coming here on my inventory. I'm going to come here and I'm going to open my bracket. I'm going to say 110,250 minus 561,880. And I got a negative. Do you still remember how much that was? That was 451,630. So I'm coming here to say it's a negative 451,630. A negative 451,630. How do I know it's negative? In brackets. So we don't forget brackets. Brackets are very essential. Okay, so we have done the calculator method. Once it's an asset we're dealing with, it's going to be previous minus current. All right, can I go on to the next one? Let's go on to the next one. In the next one now, we are dealing with our receivables. Remember, we've already done our inventory, our change in inventory. So now we're going to do the change in receivables. The first thing to consider in our receivables is your debtors. All right, let's go and look for others. If we have others, we will now say, here's our debtors as well. Accrued income, accrued income. So this is a receivable. So we're going to come here and we're going to say plus that one. All right, because it is a receivable. And then accrued expense, no, that's a payable. Accrued expense is a payable. Income received in advance, no, that's a payable. All right, so I'm going to add these two figures. Okay, so I'm going to come here so you can see what I'm doing. I have my 2022 here, I have my 2022, and I have my 2021 here. Let's start with 2021. I'm now saying 342 plus 81. What is 342 plus your 81? If you say 342 plus 81, you get 423,000. That is how you get your 423,000. There you get 423,000 here. All right. Then I'm going to say 1,279,400 plus 48. All right. 1,279,000 plus 48,000. Then I'm going to end up with 1,327,400. All right. So remember, we are still dealing with what? With our assets. We're still dealing with our assets. And when we are on the assets, what did we say? It is your previous minus current. So it is previous minus current. All right, I'm going to write the previous here. The previous is 423 and the current is the 1,327,400. All right, let's see again if we are to punch that on the calculator quickly. We will now say the previous is your 423. So it's your 423,000 here. And then we say minus the 1,327,400. Okay, let's see what our calculator will give us. The calculator will give us a negative 904,400. You can see the calculator is giving us a negative figure. So when I come here on my receivables, I'm going to now come and open my bracket. I'm going to say 423,000 minus the 1,327,400. Let's have that figure again back. Here it is, 904,400, a negative 904,400 in brackets, cash outflow. This is what we now have. Okay. And then when we're still here, let's come and now do our trade and other payables. Our trade and other payables. When we're on our trade and other payables, that is our liabilities. All right. So I wrote a bit over there. I just wrote something there. Let me show you what it means here. Here on our liabilities, it is your previous. In our assets rather, it is previous minus current. But if we come here now, it's going to be current minus previous. All right. But now, which figures do we add? All right. Which figures do we add? So remember, it's current. So let's say current. Current is 2022. We're going to take our creditors, which is 770,000. That's our creditors. Then we're going to say plus what? Accrued expense, plus 9,000 here. Then we're going to say another one, income received in advance, plus 5,400. How much do we get? I need to see calculators. Okay, so you have 770 plus 9 plus 5,400. That will give you 784,400. All right. Then you now compare it. With our previous. Our previous year is 2021. All right. So you're going to take your creditors, your trade creditors, which is 338,338. We add the same as we did here. What do we take first? Your accrued expense, which is your 8,700. Then what else do you add? Income received in advance, plus 6,200. Once we add these ones, how much do we then get? We get your 352,900. 352.9. Okay, so once we have these figures now, then we can bring in our calculators. Remember, in this case, we are now saying it is previous minus current. So when I come here, I'm going to now say, how much is my previous? 784,400 minus my previous. This is my current. Current is 784,400 minus my previous, which is 352,900. Okay, let's bring the calculator to see how much we get here. So we will now say 784. That is 784,400. Okay, then we say minus 352,900. 352,900. That will give us 431,500. Is it positive or negative? That is certainly positive. So it's a cash inflow. An increase in payables is a cash inflow. So 431,500 here. 431,500. You can see that our payables have increased. Once your payables have increased, it's a cash inflow. Okay, let's quickly now come and conclude this question. So we have started from here, profit before tax. We added our depreciation. We added our interest expense. Then we came here where we got our operating profit before changes in working capital. After that, we did the net change in working capital, whereby we added these three amounts: an increase in inventory, an increase in payables, and an increase in receivables, and an increase in payables. And then that gave us the 924,530. Then when we then add these two amounts, considering that that is a negative, you will now end up with 7,015,170. Once you get that 7,015,170, you then come here and you're going to put it now on the face of the cash flow statement. And we're going to put it under cash generated from operations. So I'm coming here, I'm going to get my 7,015,170. As simple as that. So from your note, now you go to the cash flow statement. Okay, let's quickly go now in our cash flow statement. In our cash flow statement, you will then see, as you see here, that we are going to start filling in all the information that pertains to this cash flow statement. Okay, so one of the first things that we're going to do is to record our interest paid. Interest paid. Already you can see paid means cash outflow. So the same amount that was interest expense is going to be the same amount I'm going to use for my interest paid here. Okay, and how much is that amount? That is your 219,700. So I'm coming here, it's going to be my 219,700. The very same amount. Okay, remember that was my interest expense. So here we now record it as interest paid. Brackets already, cash outflow. Okay, what do we want to do? We want to calculate the cash effects from operating activities. How many aspects come in here? 4. So far I have 1, I have 2. So I still need 2 more that I can have all my 4 items. All right, so after I've done my interest paid, let's go on to the next one. Here's the next one. Now with this one, we want to do dividends paid. Dividends paid. I know there is several short ways of doing this, but before we get to the short ways, why don't I teach you how do we eventually get to the short way? Okay, so you might say, Mr. Simbi, you're wasting time. Why are you explaining the longer way? Understand the longer way so that you can have a better understanding of this shorter way that you now have. Okay, so what we're given is 2021, 2022 shareholders for dividends. Remember, this is your final dividends. All right, shareholders for dividends. So we have the previous year's final dividends, and for this year, we are not given that amount. We are then given the share capital and dividends. So they're saying on 1 May, the directors issued a further. So there is an aspect of shares being issued here. In this question, it also demanded that you would do a note number 7 and the note number 8. But some of the questions I've removed them, all right, like your retained income. But in this question, we're going to do note number 7. It is very important so that I can show you the relationship between note 7 and the cash flow. In the next class, I'll also show you the relationship between note 8 and the cash flow statement. So these things will still relate. Okay. We now have our ordinary share capital note here. And then we are told on 1 May, the directors issued a further 2 million. That means those were not shares at the beginning. A further means there were others that were there before. Now we are issuing a further more. So that is not at the beginning. So I'm going to bring you to the next line here. That is where I'm going to have my 2 million. I'm going to come here and I'm going to have my 2 million here. 2 million. Okay, I'm just going to say issued. These are issued at 2.75 Rand. So these are issued at 2.75 Rand. Okay, later I'm going to talk about this amount that we're about to calculate here. All right, calculators please. 2 million times 2.75 Rand, that will give you 5,500,000. Okay, are we still together? Thank you. And then we are then told an interim dividend of 22 cents was paid. So we don't know how many shares was this interim dividend paid to. Let's still go. On 30 November, 500,000 ordinary shares were repurchased from a disgruntled shareholder. So that means here we have a repurchase of how many? 500,000 shares repurchased. All right, these are repurchased. We do not know the amount at which these shares were repurchased at. Are we able to get that? Certainly, because we have these amounts here at the bottom. Because after the repurchase, there was no further issue of shares. So it means I can use my amounts at the bottom to get the average price. All right, so I'm going to come here and I'm now going to say, to get the average price, I'm now going to say my 26 million, which is this one here, 26,250,000. So I'm just going to come on top here, 26,250,000. I divide that by the 7.5 million, which is this one here. I divide that by 7.5 million. Please punch that in your calculator. How much are we getting? We get 3.50 Rand. That becomes my average price. So my average price comes here on this side of the triangle, 3.50 Rand. All right, remember we started with the triangle in the very first class that we had on this class. If you don't have access to those classes, please just follow this page and you'll find the classes that we've done. All right, so you'll find how we introduce this triangle right from the beginning. So that is my average price. So I can come here now, say 3.50 Rand over here. So I can now come here and it becomes easy now. I'll now say 500,000 multiplied by 3.50 Rand. All right, how much do we get? Say it again. 1 million 750,000. 1,750,000. It becomes easy now to get these amounts that we're missing. How do I do that? You simply say your 26,250,000 plus, because you're going opposite now, so you do opposite of the sign, plus 1,750,000 minus the 5.5 million. All right, minus the 5.5 million. How much do you get now? You get your 22,500,000. So you get 22,500,000. All right, so this is at the beginning. And now to get the number of shares, you're going to say your 7.5 plus the 500,000. That's your 8 million minus 2 million. That will give you 6 million here now. 6 million. Now we can address this aspect now. That an interim dividend of 22 cents was paid on 15 October. So 15 October is coming after a further. So that simply means we had 6 million at the beginning and we issued a further 2 million to give us 8 million in that case. To give us 8 million. After we had 8 million, then we are told an interim dividend of 22 cents was given. So it will be 8 million multiplied by 22 cents. That will give us how much? 1,760,000. That becomes my interim dividend here. 1,760,000. That is my interim dividend. All right, let's come now. A final dividend of 12 cents per share was declared by the directors at the end of the financial year. Only registered shareholders are entitled. So how many registered shareholders? 7.5. So we're coming here to say we have 7.5 million shares in issue and they're getting what? 12 cents. How much is that going to give us? That should give us an amount. If you punch that in your calculator, you should get how much? 900,000. Okay, you get your 900,000. All right, so we are now going to come and we're now going to now say, in my dividends account, I'm going to open it with the balance owing in the previous year. In this class, I'll do a dividends account. In the next class, I'll do the note. And in the other class, I'll keep changing the methods so that you get exposed to everything. In today's class, we'll do the ledger account, okay? And then on the dividends, so we're going to take it that this is a liability account because shareholders for dividends, current liabilities. So it begins off balance brought down with 212,000 here. Then we're going to have our ordinary share dividends. All right, these ordinary share dividends, this is your interim plus final for this year. So this is the same amount that you'd find in your note number 8. Note number 8. So this is interim 1,760,000. 1,760,000. And this is final 900,000. So it's going to be plus 900,000. I close the bracket now. That is going to give me 2,660,000. 2,660,000. Okay, I know that this year's final dividends will not be paid. They'll only be paid in the next year. So here I'm going to have my balance brought down, which is the final dividend. My balance brought down, which is the final dividend, which is my 900,000. 900,000. That means here on top, it should be balance carried down. 900,000. What I now need is what was paid, the bank. All right. Now, to make this simple, remember, we add it up to see the side with the highest amount. So we're going to add our 212 plus our 2,660,000. That will give us 2,872,000. 2,872,000. So here I'm going to come, it's going to be 2,872,000. Then to complete this now, you say 2,872,000 minus your 900,000. That will give you 1,972,000. Okay, that becomes your dividends paid. Now, you will see that this 1,972,000 is made up of two figures. The first figure is last year's final dividend, which is your 212,000. Then you say plus, that is last year's final, plus this year's interim, which is your 1,760,000. That is how you end up with the 1,972,000. Because I know some of you were saying, but why take the long rod? You have to understand that the short rod was made out of the long rod. This is how it comes about. The shorter way of saying, if we want the dividends paid, we will say last year's final, which is your 212, last year's final, which is your 212,000, plus this year's interim. This is interim, which is 1,760,000. 1,760,000. Therefore, my dividends paid becomes 1,972,000. That becomes my dividends paid. Are we good? Okay, cool. If we understand this, remember what we have done here on this note. It's going to help us as we go further, as we prepare our cash flow statement when we come to the financing activities, shares, financing activities. All right, so let's go on to the next aspect then. Okay, the next aspect is going to be on your taxation, your income tax. All right, this is what we're going to do. We're going to do a tax account again today, and then in the next class we do a note, and then the next time we do something different. Okay, and we need to show it over here. We understand that the income tax for the year is 2,072,000. If we come to the first year, the previous year, that is 2021, we had a credit balance. A credit balance simply means we're owing SARS. It was a liability. So I would come here and I would say my balance on the credit side, balance brought down 160,000. All right? And then my balance at the end, or before I even get to the balance at the end, on the very same side, the credit side, we will always bring our income tax. So income tax will always come to the credit side here. So we'll always bring income tax to the credit side. Income tax, 2,072,000. 2,072,000. Then the last balance is a debit balance. That means the balance BD is 30,000. That means balance CD is here. Balance CD will be on the credit side, 30,000. Okay, what we want is the tax paid. So let's add up. We add those three amounts. That should give you 2 million. Okay, here you should get 2,262,000. 2,262,000. So we bring the same amount here again, 2,262,000. That means my bank is 2,262,000 over there. So when I come here, I can show my calculation. I'll say I had 160,000 at the beginning. I have added my 2,072,000, and I've added my 30,000. This is 30,000. That is how I get my tax paid of 2,262,000. That is how I get that figure. Are we together? Okay. So let's now go on to the entire completed part of the cash effects from operating activities. We had cash generated. Remember, we opened the note. We took the interest paid in brackets. We did the dividends and we got our dividends paid. We did our taxation paid. And then we ended up with the cash effects of operating activities, 2,561,470. It is a cash inflow. Hence you see no bracket, 2,561,470. Remember, we were doing O, I, and F. We're done with the cash effects from operating. What is the next one? Cash effects from investing activities. Cash effects from investing activities. We're going to take a quick 5 minute break, only 5 minutes, okay? So we're going to go for a 5 minute break, and when we come back, we're going to do our investing activities. See you in 5 minutes. Welcome back, dear learners. We're just gone for a quick short break. Now that we're back, we're going to continue with our activity. Remember, we're preparing a cash flow statement from the Gauteng Prelim for the year 2022. We've changed a bit of the questions so that we can be able to answer the cash flow statement completely. All right, now we have done the O part. Now we're going to do the I part, investing activities. Let's quickly go. So on our investing activities, we have already asserted earlier on that we invest in fixed assets as well as other investments such as fixed deposit. All right. So what we have here is our fixed assets. There is several methods again of doing this calculation. Now, I'm only going to show the ledger account today. In the next sessions, I'll keep changing so that you get a test of all the available methods. Okay, so in this one, I'm going to open a T account, a fixed asset account at carrying value. Very important that these amounts here are given at carrying value. So you now see that we're given the balance at the beginning, 2021. So I'm coming here. This is an asset account. So it will increase on the debit side and it will decrease on the credit side. So I'll come here and I'll say my balance brought down is 13,590,000. Okay. And then I also have the closing balance, 20 million. So I'm going to put it right under here. That is my balance brought down, which is your 20,158,970. I know that that balance should be balance carry down here, 20,158,970. I have been given depreciation. I know that once I have my assets at carrying value and we are using these assets, they will lose value to depreciation. So I'm going to bring my depreciation in this account. And you're wondering, do we have depreciation in a fixed asset account? If it's a fixed asset account at cost, you don't. At cost, you don't. But this is at carrying value. That's the key word. So I'll come and bring in my depreciation now on the credit side. My depreciation is 320,000. 320,000. Then we're told fixed assets were purchased during the financial year. We don't know how much that is. Fixed assets purchased here. Bank, we don't know. Old equipment was sold. We know that once an asset is sold, we remove it, we subtract it. So we're going to come here and we're going to say disposal. On the credit side, that is going to be 67,590. Okay, let's close off the ledger account. So we now look for the side with the highest amount so that we can get that bank amount there. All right, some of you already got the bank amount and you're telling me that your bank amount is 6,956,560. Okay, 6,956,560. All right, so this was the balancing figure there. All right, so first you had to close up that one, then that one becomes the balancing figure. So once we get our bank, then we're going to come here now. Then we're going to say fixed assets purchased. It is a cash outflow. Once we purchase assets, it is a cash outflow, 6,956,560. But we also have sold an asset. And when we sell an asset, it's cash inflow. So we have proceeds from sale of assets, which is going to be my 67,590. Okay, that is how we would do that part over there. And then we would then go on to the next aspect, which is my financial assets. So remember, we already got the fixed assets purchased and the proceeds from sale of fixed assets. On the financial assets, we had financial assets worth of 1 million in 2021, 1 million. But when we come to 2022, there is 0. What does that mean? It means our financial assets or our investments have matured. So we have received the money. We have received the money. So you would then see that the moment we've received the money, we'll come here, then we say change in fixed deposit, and we'll bring our 1 million here. Change in fixed deposit, 1 million. Cash inflow or cash outflow? This is cash inflow. Change in fixed deposit. And then let's close this part now. So it's a negative 6,956,560. And then plus. So plus 67,590 plus 1,000. Remember, that's a negative and these two amounts are positive. How much do you then get? You get a negative 5,888,970. A negative 5,888,970. Are we good? Okay. And then from here, we can then move on to the combined part. So we have our O, we have our I. Cash effects from operating and cash effects from investing. What is missing now? Cash effects from financing activities. So we go straight to the financing activities. Under our financing activities, it is not much of a challenge now, because remember we did this note 7 earlier on. Yes, when we were calculating dividends, you remember that time we opened this note. Now, when we come here, we know that when we issue shares, we must record the proceeds from the shares issued. The proceeds from the shares issued. How many shares did we issue? 2 million. So we'll come here, then we say we issued 2 million ordinary shares. At what price did we issue these shares? At 2.75. At 2.75. How much do we then get? So we'll get 5.5 million there. 5,500,000. Inflow or outflow? Is it a cash inflow or it's a cash outflow? It is certainly a cash inflow. So we have your 5.5 million, which is a cash inflow. 5.5 million, which is a cash inflow. And then the next one is the repurchase of shares, where you're told that 500,000 ordinary shares were repurchased from a disgruntled shareholder at 25 cents. So we'll come here, then we'll now say 500,000 shares were repurchased. Do I record the 25 cents? No, because the 25 cents comes here. The 25 cents is what goes to your note number 8, retained income. These are the shares that we repurchased. Do I record the 3.50? The 3.50? Certainly not, because the 3.50 goes to note number 7. Okay? So I have to have the top part. The top part, I'm now saying 3.50 plus 25 cents. That's going to give me 3.75. 3.75. This is what now goes to the cash flow statement. All right. So I'll come here and I'll now say 500,000. Multiply that by my 3.75. I close the bracket. And this must be a cash outflow. This must be a cash outflow. How much do I get? 1,875,000. 1,875,000. That is what we end up with. Okay, so very important to know that your note 7 is related to your cash flow statement. So we're not going to leave it in the statement of financial position. It will come as well into our cash flow statement. The proceeds from issue of shares. When we issue shares, we receive money. That's cash inflow. When we buy back shares, we use money. We pay. That's a cash outflow. The tricky part is when you buy back shares, you will not use the average price, neither will you use the amount above or the difference. You need to use the addition of the average plus the amount paid above, which is the 3 Rand 75. Are we good? Okay, let's quickly move on now to the last part of our financing activities, which is on the loan. In 2021, our loan was 2,080,000, but when we come to 2022, our loan is now 1,960,000. What does that mean? A loan is decreasing. I know there is a shorter way of explaining this one again, but let's try to explain it the longer way. If my liability is decreasing, what does that mean? It means I have paid. If the amounts that I owe are decreasing, it means I have paid. So once I pay, remember, it's a cash outflow. So I'm going to come here and I'm going to say now my 1,960,000 minus my 2,080,000. That's going to give me an outflow. Why an outflow? Because my liability has decreased. Liabilities only decrease when we pay. So I have a cash outflow. How much do I get here? I get 120,000. 120,000. Okay, that means I can conclude this part now. All right, let's get that part. You're saying your 5.5 million, which is a positive, minus 1,875,000 minus 120,000. How much do we get? We end up with 3,505,000 over there. So now we have all our three parts now. We have cash effects from operating activities, we have cash effects from investing activities, and we now have cash effects from financing activities. Okay, I want you to have your calculator now. And then we want to get the net change in cash and cash equivalents. We want to get the net change in cash and cash equivalents. How do we get that? We first take the amount, the green part of the cash effects from operating activities. How much is that? 2,561,470. Do you see that one? And then we come, then we say minus, because the amount from the investing activities, the cash effects from investing activities, is a negative amount. So my calculator, I must say minus already. Minus 5,888,970. Do you see that? What is the next thing now? Plus. Which one? The 3 million. The cash effects from financing activities. That is your 3,505,000. 3,505,000. How much do we get? We end up with 177,500. That is my net change in cash and cash equivalents. How much? 177,500. Net change in cash and cash equivalents. That is my net change in cash and cash equivalents. After that, then we come to the last part of the cash flow statement, which is now to get the cash and cash equivalents amount. Remember how we got the 177.5? It is our O plus our I and our F. Okay, that is how we got the 177,500. Then we have cash and cash equivalents opening balance. Opening, that's 2021. This is my opening. So in 2021, I had a positive amount and a negative amount. Can you see that? Because here I have a bank overdraft. So I would come here and I would say I have 72,000, which is positive. Cash and cash equivalents, 72,000. But I have a bank overdraft, which is a liability. That means it's a minus. Minus 147,500. Minus 147,500. I close this bracket. Punch in your calculator. How much do you get? 72,000 minus 147.5. How much do you get? Thank you. You get a negative 75,500. You get a negative 75.5. And then, since you have a negative 75.5, we are going down. We are now going to say on our calculator, we had a 177.5. Now we have a negative 75.5. So I'm going to come here and say minus 75,500. I'm going to subtract that 75.5. Then I end up with 102,000. So where do you see that 102? You see it up here on cash and cash equivalents. So I'll come here, then I have my 102,000. Okay, so once I have 102,000 here, which is the same as this one, that means my cash flow statement is balancing. Once the amount that I have, right from the top, from the O to the I to the F, and then I get my net change in cash and cash equivalents, I add my cash and cash equivalents at the beginning. Remember, it was a negative. And then I end up with 102,000. And it's the same as this 102,000. Then my cash flow statement has balance. That means everything we're doing was completely correct. Okay, once we get to that point, this is where we are now. We have completed our cash flow statement. It is complete. All right, so once your cash flow statement is complete, what else do? You collect marks. This is one of the easy topics that I want you guys to continue practicing. Remember, today is the very last class for the term. But you might be saying, Mr. Simbi, I still need more classes. There is more classes that we've already done on this class. You'll find your ledger accounts. If you don't know how to do that triangle, please go and search for this year's January and February classes where we did ledger accounts, where we were calculating average prices. We opened several note 7s and several note 8s. And then we went on to the statement of comprehensive income. If you struggle with adjustments, your problems are solved. There are lessons that we did in this class where you can go and practice on your own, in your own time. Over the holidays, please make sure you go and do lessons on the statement of financial position. There's quite a number that we've done in this class on this very same platform. And today we've introduced the cash flow statement. We're going to go for a short break, and I'm going to see you again in the new term. Enjoy your holidays, be safe, but above all, practice and work hard. Until next time, it is goodbye.